Welcome to Classic Value Investors. My name is Mariusz Konieczny, and today I have Harris Kupperman, or as they call him, Kuppy. We're going to talk today about oil tankers and shipping. So, Kuppy, thanks a lot for doing this.
Sure thing. Thanks for having me on.
Yeah, I listened to your Real Vision interview. Um, I read all of your pieces on oil tankers. So you've been following this sector for like 20 years. And in your writings, you said that what's currently happening could be one of the best investments you've ever seen in your career. So I kind of want to start off with, can you talk about shipping oil tankers in general, how you got involved in this sector, and kind of like let's go through the history of how it developed from the bull market to a bear market and how you started writing about it in 2019 and how the thesis because of coronavirus became even better.
Sure, yeah. Well, I mean, if you want to go back in history, it's a long history. But very big picture. Before we start on this, I just want to make some things clear. Tankers are terrible investments. It's a terrible industry. It's maybe as bad as mining, but when it's good, it's better than mining. And when it's good, it can be really good. And if you think of a tanker, you have a piece of steel that has roughly a 20-year lifespan. And over that lifespan, it may see one or two cycles. And it probably only makes real profits for a few quarters during the entire time it exists. The rest of the time, you have roughly an equilibrium. But when you get to earn excess profits, because of the financial leverage where incremental revenue drops to the bottom line almost 100%, and because the financial leverage, your upside could be monumental. And when this happens, fortunes are made.
You
The
you
rest
you
of the time,
you
fortunes are lost.
right, you were kind of talking about how when you caught the bull market 20 years ago, between I think it was between 2003 and 2008, Frontline, which was one of the players, went up like 50 times or something.
Yeah, it went up 50 times, and I think that's without dividends. It's a phenomenal track record of value creation. And that's what happens when things are good. Mind you, there was a 4-year period, and if you pull up a chart of Frontline, you'll see that then from 2008 onwards, it basically destroyed shareholder value for 12 years.
Right.
And so, it's worth keeping in mind this isn't Berkshire Hathaway. You're not putting this away to forget about this. But when the market is strong, it's unusually strong, and management teams who have stock options often pay pretty good dividends. So you get a decent chunk of the money back between dividends and buybacks, and you just got to know when to get out also. But, part of getting out is knowing what your thesis is and when you want to get in. So let's go talk about why I think the opportunity right now is so damn attractive.
Okay.
Well, I guess let's frame it with your original question, okay? So you were asking, what happened last cycle. So, quick history lesson. Exxon Valdez ran aground. It polluted offshore Alaska quite badly. And a bunch of international organizations got together and they said, we need to have double hull tankers so this can never happen again. And there was a very bureaucratic, dysfunctional phase out of single hull tankers and phase in of double hull tankers. And it created this kind of nebulous period of time where both existed simultaneously. So vessel owners were ordering these double hull tankers because they knew they needed them, but the single hulls, the phase out kept getting postponed. And you had the situation where there was way too many tankers on the ocean and everyone lost fortunes. They had just bought these new tankers. They were very expensive. They had to finance them. You had these old tankers that were supposed to be obsolete, but didn't seem to go to obsolete. And a lot of people in this industry almost went bankrupt. Quite a few of them did go bankrupt. And it was just really terrible. And if you think of a cyclical industry, that's usually how you get to a bottom. Eventually everyone goes bust. And so that was basically what happened in tankers. And then starting in 2003, oil demand, transport demand started to pick up. The U.S. came out of its small recession. China started waking up. A lot of the rest of Southeast Asia really had a boom, and tanker rents went crazy at a time when they were starting to phase out these double hull tankers. And the net result of all of this is that tanker rates went to multi-year highs. You know, people forget, I think, that from 2003 to 2008, that the average for a VLCC was 65,000. People forget that there were moments, very scary moments during this time, where tanker rates went below the cost of operating a tanker. There were periods where tanker rates went over 100,000. Tanker rates are volatile on a weekly basis. They're volatile between different, production and transport routes. There's a lot of volatility, and there's no such thing as a true rate. It's really, what the price is today when someone has a tanker that's positioned appropriately to move a cargo. And so people, I think, forget just how volatile it was over that 5 year period. And the average was 65,000. But yes, Frontline was a 50 bagger. And, eventually, as they always do in these cycles, they ordered too many vessels at a time when we ended up with the GFC. And then even after the GFC, they just kept ordering and ordering vessels because everyone thought it would come back. And it did come back. Oil demand in China this year is a lot higher than it was in 2008 or 9. But it's supply and demand, and they just ordered too many tankers. And they've just really crushed the supply side. And they finally stopped ordering in about 2016, where we hit bottom.
So are you okay? So from 2003 to 2008, the great bull market, and as a result, they ordered a bunch of vessels, and I have it here that in 2008 the order book was like 46% of the fleet. I mean that just ridiculous.
It,
But are you saying that after 2008 they kept ordering, or
yes,
or the vessels just kept getting delivered because there is this period of time where it takes 2 years from the time you order?
both. I mean, if you were sitting there in 2008 and saw what the order book looked like, you should have been shorting as many tankers as possible. It was just obvious that you can't have 50% fleet growth at a time when demand's not growing that fast. I mean, it's just it's not physics; it's simple algebra, and so it should have been obvious. And people just kept buying these things. And then what you had a lot of PE funds who, these aren't tanker guys. If you look at, I think tanker guys, the executives of these companies, they sort of get a bad rap, and there were some bad players. But a lot of the tanker executives were warning this is a crisis coming. I remember it back then. We had a lot of PE funds that said, we're going to buy a couple tankers secondhand, and then we're going to do an IPO, and we're going to order 20 vessels, and we're going to earn management fees and chartering fees and all these different fees, and we're going to start our own tanker companies. And that's really, it was the PE guys that caused the problem. It wasn't really the tanker guys. I mean, the tanker guys were the ones selling vessels to the PE guys. I just don't think the tanker guys realized how bad the cycle would be on the downside, or they would have sold all their vessels. But yeah, not only were they still getting delivered, at past 2008, but they were still ordering vessels into a time when charter rates basically went to break even.
Wow. So I see from the charter rates, okay, in 2008 they were high and then they started to go down from 2008, and I think they went to a low in 2012, and then they started to go up again. So what happened during that time?
Well, I mean, this volatility in rates month to month, year to year. Obviously, if rates started going up, you saw some sort of equilibrium. I really don't want to. I mean, look, we can go year by year and say, well, this happened, that happened, but
Right.
I think it's missing the big picture of, you had a period of time where there was too much supply and they kept ordering, so
Okay.
you didn't see new highs. I mean, 2012, you had a little bit of a bounce when there was a storage glut in 14, 15, 16, but you didn't see new highs. You just saw like lower highs in a downtrend. And every time you saw a bit of a recovery in rates, guys just ordered more tankers, which is why charter rates could never get out of their own way, and they just kept heading lower because you had all this more supply coming, even at a time when global transport demand was increasing.
Right. And then on the previous interview that I listened with you, you were saying that like between 2016, something like that, a lot of them either went bankrupt or consolidated or diluted a lot. Can you talk a little bit about that?
Well, yeah, I mean, look, if you're the owner, I mean, well, let's take a step back. Most
Mhm.
tanker companies went public not because the majority owner thought it was, nice to go share some of the profits with outside shareholders, and not really because he needed outside capital to grow his fleet, because a lot of these guys actually had reasonably sized fleets. They went public because their goal was to earn a bunch of fees. So you have brokering fees and chartering fees and maintenance fees. There's so many different fees that if you have a decent sized fleet, you make a fortune as the majority owner. And so when things go bad, you're not going to go bankrupt as the majority owner. You're just going to get diluted dramatically, and you're going to do down round after down round after down round because you don't make your money because you own 10% of the company. You own your money. You make your money because you're getting paid millions of dollars a year in fees, and then eventually you claw your way back into your ownership of the company because you give yourself restricted shares or stock options or something. So when you went into this period of time from about 2009 really until 2018, where excluding a few short-term spikes, you really had, break even at best cash flows and often negative cash flows. And this is all, when we talk about tankers, we're going to talk about cash flow. There's this, conversation, but you have to remember that when you have a vessel that lasts 20 years, I mean, depreciation is a real expense. So as you're going on in time and you're breaking even a cash flow, you're from an accounting perspective, you're losing a fortune. And that depreciation, the banks are watching it, which is why they have very aggressive debt amortization also. So you might be break even on cash flow, but your debt amortization is going to be chewing up your capital, and you're going to need outside capital to keep the bankers at bay.
Right, right. So at what point did you start seeing it turning, and that's when you got interested?
You mean this cycle?
Yes. Way before, because you got interested again way before the coronavirus.
Oh yeah. So look, I've been watching this thing called IMO 2020. What IMO 2020 says is that starting January 1 of 2020, you have to use low sulfur fuel or you have to install a scrubber. And I looked at this as something of a winnowing function on the fleet, which the fleet, you have a lot of older vessels in the fleet. And, I said it's going to be more expensive to use low sulfur fuel. And I said guys with older vessels are probably not going to install scrubbers. And we did see a lot of scrapping in 2017, 18, early 2019. So you had this period where the fleet was growing less rapidly. And I was looking at this and saying, you finally have a catalyst to see a recovery in tanker rates. Because when you look at the forward order book, after a couple of deliveries that we just saw in early 2020, there really aren't any deliveries scheduled for the next 2 years. And so you have a period of time now where you might even see negative fleet growth depending on how much scrappage you have because you really don't have much in the way of new orders. And then you also, because of coronavirus, a lot of the shipyards are closed down. But I mean, looking at this in early 2019, you can look at the forward order book and say you're not going to have a lot of orders. So if demand stays reasonably robust, you should see a recovery in tanker rates. And that's really what we saw in 2019. A lot of guys, as I said, there was a bunch of scrapping in 18. There was some more scrapping in 19. You had a bunch of guys, take their vessels out of service to put scrubbers on. But what really started this whole recovery was when President Trump sanctioned COSCO vessels. And if you think of tankers, tankers are really just a play on geopolitical volatility in a lot of ways. It's supply demand, obviously, but when you have small changes in supply demand that create such big moves, oftentimes those changes are caused by geopolitics that change existing trade routes. Or in this case with Costco, what it did was it took some vessels out of the fleet. And you got to see just how sharp that spike was. And because of the magnitude of that spike, it kind of told you that hey, this fleet is getting into balance. I mean, when you think of tankers, and I think this is one of the things that Wall Street guys make a mistake. They're very used to looking at the price of copper, which it's volatile day to day, but it kind of stays in a 20-cent range for months at a time. Whereas tankers, they have spikes and they pull back, the spikes and they pull back. And even during the course of a year, that's going to give you a very good average charter rate. You're going to make most of that average on those couple month spikes along the way where you spike up very high and then you pull back. But those spikes are what tells you when the market is at an equilibrium. You can read as many broker analyst reports as you want. it doesn't really matter. But when you see 26 vessels leave the global fleet and charter rates go to 300, I mean, even if they didn't get fixed there, it just shows you that 26 is the magic number for tightness, and the market's tight. That's 3%. And so, I mean, that's what got me really cued in on tankers, and got me increasing my positions dramatically. I was already really heavy in the product tankers, and that's what got me into the dirty tankers as well.
Okay, that's what that was the thesis prior to coronavirus. The demand was for the transportation was going to continue going up, and the supply of the vessels was restricted. And then boom, then we get the coronavirus, and the demand gets destroyed. Yet the thesis gets even better. So can you talk about that now?
Yeah, sure. I mean, when we look at what happened before coronavirus, in kind of big picture, you have to look at what's happening in the market that tightened the market. Because, the fleet is still growing, and global oil demand doesn't grow as fast as the fleet's been growing. So you say, why is the market tightening if the fleet is growing faster than global oil demand of about a million barrels a year? And what really was happening is, if you look at incremental demand, that was mainly coming from China, India, Southeast Asia. And you look at where incremental supply was coming from, that was coming from U.S. Gulf of Mexico, Brazil, West Africa, Norway, Guyana. And, you just look at a map and say, well, I mean, a lot of this supply is coming from much further away than the Middle East, where previously supply was coming. So if it takes 2 to 3 times as long to transport the oil, then of course you're going to need more tankers. And that's why the fleet can be growing at a faster rate than global oil demand. And that's the big catalyst. Well, what happened with COVID is that all of a sudden the world kind of had a heart attack,
Right,
and
right,
so what you had is a huge increase in sorry, a huge decline in on the demand side. And after you fill up the land storage, you have to fill up the floating storage. There's nowhere else to put it. So when I saw this happen, I mean, as soon as I saw this COVID thing start happening, tanker stocks just started collapsing. Even the first couple of days in China, when there were only a few hundred people infected, tanker stocks started collapsing. And so, it was kind of terrifying for a bit. But then I realized that COVID was probably going to jump the border and come to other places, and you start seeing it impacting other countries. And I just bought every share I could because I just knew what was going to happen. And I didn't know we'd get to 30 or 35 million surplus, but I knew you were going to tie up a lot of vessels, and I just knew how bullish that was. And I mean, if you look at a VLC, it stores 2 million barrels. So if you're really looking at, say, 20 million a day, let's say that's where that's where equilibrium is in early May. I mean, you're talking about 10 vessels a day leaving the ocean. And what I think people are really missing here is that I don't think we get to an equilibrium moment for a very long time, because I think demand has taken a permanent hit for a while, and the supply side is only going to slowly come off. I could see us taking until year end before we hit that equilibrium again. So, maybe, we're not growing at 20 million of surplus daily, but, even in Q3, you might be low single digit surplus, which is, a vessel or two a day that's coming out of the fleet. And, if you're a country in the Middle East, you're West Africa, you've got to turn this oil into dollars and you got to transport it. So there's still demand for transport too. And that's what's led tanker rates to go to all-time highs, historic highs, 10-year highs, 20-year highs. I mean, just look at a chart. It's crazy. And that's why I think rates are going to stay very elevated for a long period of time. Because if you work this backwards, and I mean, my guess is as good as yours, but let's say the average in 2021 is a 5 million deficit. Okay, let's say demand is 90 million and supply is 85 million. Um, those are just made up numbers. You can plug your own numbers in. But let's say it's a 5 million deficit. If you have 2 billion barrels build up, you're talking about 400 days. If you have 3 billion barrels build up, you're talking about 600 days. If you're at 1 billion barrels build up, you're still 200 days. And I mean, I don't think the number in storage is going to be a one. It's going to have something either a two or three in front, which means that this trade's going to go on for 2 or 3 years, which, I think you're going to have excess earnings for a very elongated period of time. And, going back 10 minutes to what I talked about earlier, these cycles are short, they're fast, and you make a ton of money.
right. I was kind of surprised to learn that, I mean, the thesis to you and me is pretty obvious. But when I was listening to the shipping conference, and the CEOs of these companies were talking, they were bullish, but they were cautiously bullish, as I would say. But the finance guys, they weren't bullish at all. And I realized that there's some people who are actually bearish or short this sector. Uh, can you even talk about it? Like, why would they be short? Why would they be bearish this sector?
So, I mean, let's look at this kind of from a big picture standpoint, okay? So I do a lot of inflection investing. That means we're usually in my hedge fund is usually investing in some sector that's gone down for a lot, that's destroyed a lot of capital, that's upset a lot of people and frustrated people to the point where anyone who's tried to call a bottom has, almost immediately regretted it. So you have a lot of shipping executives that for 12 years at these industry conferences have got up on stage with a bull thesis and said, this is the year for the recovery. These are my reasons why. I'm super optimistic. And then they look like idiots next year. And so at some point, you got to save what little credibility you have left and be a little bit less optimistic. I mean, privately, these tanker guys are just flipping over themselves how bullish they are. You talk to guys who are trading physical, and they're telling me in their private, their personal accounts that they're 120% long tankers because they just know how much money will be made in contango. Um, and then you have the equity analysts, and I don't really know what these guys are thinking, but I mean, a lot of these guys still have 40,000 as the average for VLC earnings this year, which in a historic year would be a pretty robust number compared to the last few years, actually. So I mean, they're saying rates are up year over year, but when you plug 40,000 in and you realize that, we're second week of April right now, so charters booked today, they kind of have a loading at the end of April, and they usually run the whole month of May and a decent chunk of June. We already know what the first 6 months of the year look like, and we're north of 100,000. So to get 40,000, I mean, you need the back half of the year to be negative. And that's just not how math works. So,
Right.
um, when you look at these analyst reports, you just wonder what these people are smoking because, I mean, their numbers are too conservative. But I mean, when you're a Wall Street analyst, there's no investment banking to do, and you've basically been telling your hedge fund clients for years and years to buy, and they lose money. At some point, you just want to keep your job, and you want to actually have them beat the number for a change. And I think these guys are just scared of their own shadow at this point.
Yeah.
I mean, but then you have you have this kind of like circular loop where friends of mine that run money at funds call up the analyst because they want to speak to someone who's supposed to be unbiased, and the analyst is bearish, and these guys are saying, "Oh, Cuppy, you don't get it because of this and this," and then you walk through the why this and this isn't that meaningful, and they're like, "Oh, I got to call the analyst to get more." It's just I think people this is what you see happen at bottoms. People are scared. This false starts. It's very jagged and volatile because the trend is reasserting itself from one direction to the other, and the trend for 12 years is down. And so every time there's a bad data point, every time Trump tweets something, I mean, tanker stocks are going to drop 20%, and all the guys who are bearish are going to say, "See, I told you." And this will just work its way through. This is how bottoms get made.
Yeah, yesterday or 2 days ago, for the first time, because I saw a lot of articles on the topic that we're running out of storage, right? Because the demand is distracted, the supply is here, and the oil has to go somewhere. But 2 days ago, for the first time, I saw an article, and I'll link to it below, that someone was saying that we might need 440 VLCCs to store the excess oil within a very short period of time. And just to put things in perspective, there's only like 800 of them out there.
Right, right. And look, if we end up using 440, I'm going to retire on this trade. but but no, I think you need to look at this from perspective. It's not there's magnitude in terms of if we use 440, tanker rates are going to go very high. Though, look, after the OPEC was announced on Thursday, we had two charters booked. One was 220,000, one was 257,000. Those, in a historical perspective, are all-time highs. more or less. And so after the OPEC scary press release, guys still need to move their oil, and it's a commodity industry. You pay what the market price is. So, if we normalize at 200,000 or even 100,000, and please, guys who are long these things, don't get panicked out every time the rate drops 50,000. It bounces around a lot. It's volatile. You're looking at some number produced by some journalist that doesn't understand that you have different rates, different things that go into the rates. You have different routes. These just move around a lot, and you can't get caught up in the number. But let's say we even drop to 100,000 for here. I mean, those are outstanding rates. The other question is how long it lasts. And I think that's the other part where you could look at this and say, I think this is going to last a very long time. I think a lot of people, one, keep saying this is a very short term spike. That's why 250 doesn't matter. And I
Right.
say at 250, you earn your market cap every quarter. So it does matter. But then, I think a lot of people are worried this is very short term. And I hope my, math on this is 400 to 600 days from the date of equilibrium is meaningful to people because 400 to 600 days is a very long time when you earn your market cap every quarter.
Yeah, that's right. And what about the discussion that they have right now about oil cuts? Because last time I saw an article, they were like, "Oh, we're gonna cut 20 million between Russia and Saudis," and I'm thinking to myself, "Well, how's that possible? If two of these countries produce about 20 million, they can't cut 100% of their 100% of their production, right?"
So the production's going to get cut. It's either going to get cut because they all sit together in a room and decide it, or it's going to get cut because there's literally nowhere to put the oil. But it's going to get cut. Okay, that's obvious. And if you're plugging in 103 million as your supply number, you're really not paying attention. But it's a question of when it gets cut. And even OPEC is saying there's no cuts until May. So I mean, at 25 million barrels. We're at 750 of inventory build for the month of April. If we're at 30 million, you're looking at 900 million of inventory build. I mean, I think that's the really important part is how much inventory you're going to build before the cuts even take effect. And look, they're going to cut. I don't think they're going to cut 20 because they just can't cut 20. But they're going to cut, and other nations like the U.S. will cut, and Canada will cut, mainly because it's a business, and you're not going to produce something at a loss indefinitely. But I think the cuts will come slower than people think. And in the day you issue the press release, you probably still have, inventory you need to drain down. You can't. It's not a switch you just flip. From the time you make a decision at the board of directors level, we will cut production. It takes a few weeks. So and if you see, like, we're building up oil at 20 to 30 million a day right now, like, you don't need that many days of that sort of build to get to a point where it takes hundreds of days to unwind it all.
Right. So what you're saying is that if we are producing a surplus of 20 to 30 million barrels per day, I mean that takes out a bunch of vessels every day out of the market, and they're going to be tied up storing the oil until we actually see this reversed, meaning that there is more demand than supply for the oil, right?
Yes.
Right, and this is what you're saying, that this could last for a long time because let's say if they end quarantines tomorrow, I mean the demand is still not going to go back up to where it was before because who's going to go on a cruise at the beginning? Who's going to start flying right away? It will take some time for things to go back to normal.
Oh, of course. I mean, look, if you look at some big numbers, and I hate to get deep into the weeds, I tried to build a spreadsheet this week of exactly how many barrels are offline. And you kind of go country by country or sector by sector, and you go, airlines down, X, and gasoline in the United States is down by Y. And you try to build this big model, and you realize that your model is only as good as the estimates. And, my guess, I mean, look, I'm looking out my window at a very busy road, and there's maybe a car every 30 seconds. And normally it's a traffic jam on a Sunday as everyone's trying to go to South Beach. So, maybe demand for gasoline in South Beach on Alton Road is down by I don't know, 80%, 90%. But then how do you plug that into the rest of the country? I just think you end up with a lot of data errors. But when you look at the big drivers, which is going to be gasoline usage, you know, shipping usage. I mean, look, if tankers are storing oil, they're not burning oil. Put it that way. Jet. I mean, jet is 8 million a day. That might go to 2 million. And you start working backwards. I don't see how demand goes above 90 in a long time. Um, you know, all my conferences that I normally go to each year are canceled this year. I'm not getting in a jet plane for a long time because I have nowhere to go.
Right, right. Yeah, very interesting. I mean, like you said it in your reports, that this could be one of the best investments you've ever made in your entire investing career.
So one of the things I really like about this investment, beyond the fact that I really do think these tanker companies are going to earn their market cap every quarter for multiple quarters, and some of that's going to come back to me in dividends, some of that's going to come back to me in buybacks, some of that's going to be stolen by these management teams, and I just accept that as a fact of life. Um, but
Right.
I mean, what I like about this is almost every investment I've ever made in my career has followed the format of I have a thesis. If X happens, plus Y happens, but not Z, then this happens and I make money. And it's always one of these long drawn out theses because the market's usually pretty efficient at seeing this stuff. And so you have to be ahead of the market seeing something happening. And what's odd about these tanker stocks is that tanker charter rates are at all time highs. Excluding 2 weeks in end of January, they've effectively been at all time highs for 6 months now. We know Q1 is going to be phenomenal. Q4 was great, and Q2 is going to be better. These companies have paid off a ton of debt by the end of Q2. The charter's already booked in hand. These companies have retained a lot of capital, which increases the NAV. And the thesis is actually playing out phenomenally well. I keep telling people this is like standing there in 2009 and being able to buy a CDS on housing that paid off 20 times, but getting the 2006 price. I remember in 2006, I lived in South Beach at the time, and I remember, it just seemed like a bubble. It seemed crazy. There were guys, buying 10 homes at a time and speculating in condos, and a couple $1,000 down, you bought $1 million condo. I just knew it was going to end in tears, but I didn't know how much longer it would go. I shorted a bunch of housing stocks. I shorted some financial stocks, the Countrywides and the Lehmans and the Bears of the world, and I got ran over short because I was too early. And in 2007, when everyone in my condo building started defaulting on their mortgages, these stocks kept going up still, and I was short and I got ran over. And you could be too early because you're right on the thesis, but your timing's wrong. And the thesis isn't really playing out. And here's one of those few times where the thesis has played out. You're actually getting paid. You're past the risk part because of the retained earnings have de-risked the companies. So even if something really terrible happens, I feel like I'm going to get my money back, plus or minus 20%. And I don't know what that terrible thing that happens that destroys tanker earnings right now. And, what I'm saying is you don't have this if X plus Y minus Z scenario. It's happening. It has happened.
Yeah, yeah. Very interesting. Yeah, I don't have any other questions. Thanks. I mean, if you want to add anything else, then we're good.
I just add one more thing. You know, I see a lot of people emailing me and they say, "Well, Cuppy, this happened. What does it mean? Cuppy, this happened. Are you selling?" Like I'm the sort of investor that has a thesis,
Hmm.
and I test my thesis every day as new data comes out. But unless something really impairs my thesis, I'm going to ride with it. And there's bits of new information that come out every few minutes. It's a global industry, and nothing's really testing my thesis. My thesis is that you will have an increase in supply. That supply will take a lot of tankers. Those tankers will eventually lead to a very deep contango. The contango will narrow and steepen, and the contango on the very short term is determined by just where the futures are trading. But longer term contango is determined by storage costs, and that contango will continue to widen, and it will incentivize people to store oil on tankers because they're traders, but it'll also people will be forced to store oil on tankers. So I'm not focused on the day-to-day change in the contango. I'm really focused on the fact that you're going to have 2 to 3 billion barrels that build up in excess of normal. It'll take a long time to unwind that, and tanker companies should earn excess earnings for a long period of time. And you can't focus on what the earnings are this week or last month. It's a big picture sort of thing. And, I would just tell everyone that wants to look at tankers to stop, take a deep breath, analyze what I've just said, analyze your own interpretation of what's going to happen, and, come to your own conclusions and don't rely on me.
Yeah. Well, okay. Well, thank you very much. And
Sure.
I also wanted to thank you because you're the one that introduced me to this idea. Uh, y- and I read all of your reports. I went all the way back to 1999 and I read every single annual report of Frontline. So the past, two weeks or 3 weeks, I mean, my life is all about tankers. So, and I wanted to do this interview because now that I did all this studying, I was like, okay, I'm ready to ask some educated questions. Uh, but yeah, so I just wanted to say thank you once again for introducing me and helping me along the way to understand the thesis.
I'm happy to do my part, but don't thank me until we actually have gains.
Yeah, that's right. Fair enough. Okay, well, have a good day.
Sure.